platinum bombshell. Silver stackers aren't ready. For what if the next major move in silver isn't being signaled by silver at all? What if the warning has been hiding inside another metal, one that most investors rarely watch, while institutions have quietly been paying attention? For months, headlines have focused on gold, but beneath the surface, platinum has been making moves that could reshape the entire precious metals market. History shows that when this rare metal behaves differently, something much bigger is often developing behind the scenes. The question is, why are experienced commodity traders suddenly watching platinum so closely? And what do they see that millions of silver stackers still don't? The answer could change the way investors look at silver forever. Before we uncover what's really happening, welcome to Next Alert, where serious investors stay ahead of the headlines, not behind them. If you're someone who believes protecting your wealth starts with understanding the facts, take a moment to subscribe and become part of our growing community. And if you're joining us today, we'd love to know where you're watching from. Tell us your city and country in the comments below. We read every one of them. Now, let's uncover the platinum bombshell that almost nobody is talking about. For years, most precious metals investors have believed that gold leads the market and silver follows. It is a simple narrative that has shaped countless investment decisions. When gold rises, attention shifts to silver. When gold weakens, many expect silver to struggle. But beneath this familiar pattern, another metal has quietly begun sending signals that professional commodity traders rarely ignore. That metal is platinum. At first glance, platinum appears too small to matter. It receives only a fraction of the media coverage that surrounds gold or silver. Daily trading volumes are significantly lower. Investor participation is smaller, and many retail stackers never consider adding it to their portfolios. Yet history has repeatedly shown that smaller markets often reveal changes before larger ones can react. That is exactly why the recent movement in platinum deserves careful attention. Over the past several months, platinum has experienced unusually sharp price swings. While many investors dismiss these moves as temporary volatility, institutional traders started asking a very different question. Was platinum simply reacting to short-term market conditions, or was it quietly signaling a much larger shift inside the global commodities market? The distinction matters because platinum occupies a unique position unlike any other precious metal. Gold is primarily viewed as a monetary asset and a store of wealth. Silver serves both monetary and industrial purposes, making its price sensitive to economic growth as well as investor demand. Platinum, however, lives almost entirely at the intersection of scarcity, industrial production, and global supply chains. That combination makes it extraordinarily sensitive to changes long before they become visible elsewhere. Professional commodity desks understand that markets rarely move in isolation. Capital constantly rotates from one asset class to another, searching for value before the broader market recognizes emerging opportunities. Sometimes those rotations begin inside smaller, less liquid markets, where relatively modest buying or selling can create outsized price movements. Platinum is one of those markets. Its limited liquidity means institutional positioning becomes visible much sooner than it does in gold or silver. Large investors understand this dynamic. They monitor platinum, not because they expect it to outperform every year, but because its behavior frequently exposes changes in risk appetite, industrial demand, and supply conditions before those forces spread across the broader precious metal sector. This is where silver investors may be overlooking an important signal. Many stackers spend countless hours following silver inventories, futures positioning, mining output, and central bank policies. Those indicators remain valuable, but they often describe what has already happened rather than what may happen next. Platinum, on the other hand, can function as an early warning system. When industrial expectations improve, manufacturers begin securing critical materials. When supply concerns emerge, smaller markets often react first. When institutional capital starts repositioning, it usually enters overlooked sectors before attracting widespread public attention. These developments rarely make front-page news. Instead, they unfold quietly, one transaction at a time, while financial headlines remain focused on larger markets. The current environment appears remarkably similar. Inflation continues influencing production costs. Interest rate expectations remain uncertain. Global manufacturing activity is attempting to stabilize after years of disruption. Meanwhile, geopolitical tensions continue affecting the regions responsible for producing most of the world's platinum. Each of these factors creates pressure on an already constrained market. Individually, they may seem manageable. Together, they have the potential to reshape pricing across multiple precious metals. The question is no longer whether platinum matters. The real question is why sophisticated investors have begun watching this overlooked metal so closely, while much of the public remains focused elsewhere. Because if platinum is once again sending an early signal, silver may not be far behind, and the next phase of the precious metals market could look very different from what most investors expect. Imagine waking up tomorrow to discover that the world suddenly lost access to more than half of its platinum supply. It sounds like the beginning of a financial thriller, Yet for professional commodity traders, this is not an impossible scenario. It is a risk that has been quietly growing for years. Unlike gold, which is mined across numerous countries, platinum production is concentrated in remarkably few places. Nearly all of the world's newly mined platinum comes from just two regions, South Africa and Russia. That means a labor strike, an energy shortage, new sanctions, political instability, or transportation disruptions in either country can send shockwaves through the global supply chain almost overnight. This concentration creates a level of vulnerability that many investors underestimate. When businesses depend on a scarce resource produced by only a handful of suppliers, every disruption becomes magnified. Manufacturers cannot simply replace platinum with another metal overnight, especially in industries where performance and durability are critical. Instead, they compete for an increasingly limited supply, often paying significantly higher prices just to secure future deliveries. That competition is already becoming visible. For decades, platinum was primarily associated with luxury jewelry and high-end investment products. Today, its role has expanded far beyond those traditional markets. It is essential for automotive catalytic converters, hydrogen fuel cell technology, petroleum refining, chemical manufacturing, medical equipment, and several advanced industrial processes that support modern economies. In other words, platinum is no longer simply a precious metal. It has become a strategic industrial asset. This distinction changes everything. Gold can experience strong demand even during economic weakness because investors seek safety. Platinum, however, responds to an entirely different combination of forces. It reflects both industrial confidence and physical scarcity. When those two drivers begin moving together, price movements often become far more aggressive than most investors anticipate. Now consider the current global landscape. Governments are investing billions into energy transition projects. Manufacturers continue expanding technologies that rely on platinum-based components. At the same time, mining companies face rising operating costs, declining ore grades, electricity shortages, and increasingly complex environmental regulations. Supply growth is slowing just as long-term demand continues to build. That imbalance rarely resolves itself quickly. Commodity markets have demonstrated this pattern repeatedly throughout history. Years of underinvestment create hidden shortages that remain invisible until demand suddenly accelerates. Once inventories begin tightening, prices can adjust with remarkable speed because physical supply cannot be increased overnight. Opening a new platinum mine is not a 6-month project. It often requires years of exploration, financing, permitting, construction, and infrastructure before a single ounce reaches the market. This delay creates one of the most powerful forces in commodity investing. Demand can change in weeks. Supply often requires years to respond. Institutional investors understand this timeline exceptionally well. Rather than waiting for shortages to appear in newspaper headlines, they monitor production trends, export data, inventory levels, and geopolitical developments long before the broader market reacts. Retail investors rarely see these early signals. By the time shortages become common knowledge, much of the strategic positioning has already taken place. This is where silver enters the conversation once again. Silver shares many industrial characteristics with platinum. Both metals are deeply connected to manufacturing activity, technological innovation, and global economic expansion. While they serve different industries, investor psychology often links them together during periods of tightening commodity markets. When institutions become increasingly optimistic about industrial metals, capital rarely flows into only one asset. It begins spreading across the entire sector. That is precisely why platinum deserves far more attention than it receives today, because what appears to be an isolated supply challenge may actually be the first chapter of a much larger transformation, one that could eventually redefine how investors value silver itself. What if the biggest mistake in today's precious metals market isn't buying the wrong metal? What if it's watching the wrong signals? Every day, thousands of investors refresh gold charts, monitor Federal Reserve announcements, track inflation reports, and study silver inventories. These indicators dominate financial headlines and social media discussions. They are important, but they all share one problem. By the time they become obvious, the market has often already adjusted. Professional commodity traders approach the market differently. Instead of asking where prices are today, they ask where capital is quietly moving before everyone else notices. The difference separates followers from leaders. Institutional investors rarely concentrate on a single precious metal. They study the relationships between multiple commodities because markets constantly communicate with one another. Gold reflects monetary confidence. Copper measures industrial activity. Platinum reveals pressure within strategic manufacturing. Silver sits at the intersection of all three. This makes silver one of the most responsive assets in the commodity complex. It reacts to changes in investment demand, industrial production, technological innovation, and macroeconomic expectations simultaneously. That flexibility creates enormous opportunity, but it also makes silver far more complex than many investors realize. Most retail stackers focus almost exclusively on silver-specific news. They track bullion sales, coin premiums, mining reports, and exchange inventories, while assuming these are the earliest indicators available. In reality, they may simply be observing the final stage of a much longer process. The first clues often emerge elsewhere. Consider how institutional money behaves during periods of economic uncertainty. Large investment firms rarely deploy billions of dollars all at once. They gradually rotate capital towards sectors they believe are becoming undervalued or strategically important. These movements begin quietly, often inside smaller markets where pricing reacts much faster to new demand. Platinum has historically been one of those markets. Because it trades with lower liquidity than gold or silver, even modest institutional buying can produce noticeable price movements. Those shifts may appear insignificant to casual observers, but experienced commodity analysts recognize them as valuable information. They are not simply watching platinum, they are watching the decisions of the investors buying platinum. History offers several examples where industrial metals began strengthening before silver experienced its most significant advances. Improving manufacturing activity, tightening supply chains, and renewed industrial demand frequently appear first in smaller commodity markets before expanding across the broader precious metals sector. Silver rarely moves in complete isolation. It absorbs information from every corner of the global economy. That includes factory output, energy costs, transportation networks, government spending, technological investment, geopolitical risk, and industrial confidence. Every one of these forces influences silver directly or indirectly. Ignoring those connections creates an incomplete picture. This is why sophisticated investors build what they call an intermarket framework. Instead of analyzing one chart, they examine dozens. Instead of relying on one headline, they compare multiple industries. Instead of reacting to today's news, they search for tomorrow's catalyst. That discipline allows them to identify opportunities before public attention arrives. Today's market may be entering another one of those moments. Platinum continues attracting renewed interest. Industrial demand remains resilient despite economic uncertainty. Supply constraints have not disappeared. Capital is beginning to rotate through sectors that many retail investors continue to overlook. The question is no longer whether silver has long-term potential. The question is whether its next major move has already begun forming beneath the surface, hidden inside markets that most silver stackers never thought were worth watching. If that is true, then the smartest investors are not simply accumulating metals. They are learning to recognize the signals that appear long before the headlines do. Every major commodity cycle begins the same way. Not with breaking news, not with television analysts announcing a new bull market, and certainly not with the public rushing to buy. It begins in silence. Long before headlines declare that a new trend has arrived, institutional capital is already moving. Pension funds, commodity trading firms, hedge funds, and multinational corporations do not wait for confirmation from financial media. They position themselves while uncertainty is still high and prices remain relatively misunderstood. That may be exactly what is happening today. Across global markets, investors are trying to answer one critical question. What does the next economic cycle actually look like? Will inflation remain stubbornly elevated? Will central banks eventually reduce interest rates? Will manufacturing recover faster than expected? Will geopolitical tensions continue disrupting the global flow of strategic resources? Each answer points toward a different investment strategy. Yet one fact remains remarkably consistent. Physical commodities become increasingly valuable whenever supply struggles to keep pace with long-term demand. Platinum now finds itself at the center of that equation. Unlike financial assets, precious metals cannot be created with the click of a button. Every additional ounce requires years of exploration, mining, refining, transportation, and investment. That physical limitation gives scarce resources an advantage whenever demand accelerates unexpectedly. This is why experienced investors spend so much time studying market structure rather than daily price fluctuations. They understand that prices move because underlying conditions change, not because headlines suddenly become optimistic. Those underlying conditions are becoming increasingly difficult to ignore. Governments continue investing heavily in advanced manufacturing and energy infrastructure. Industrial demand for strategic metals remains resilient despite slowing economic growth in several regions. Supply chains are still adapting to geopolitical uncertainty, while mining companies face higher costs and stricter environmental requirements. These forces are not temporary. They represent structural changes that could influence commodity markets for years. For silver investors, this creates both opportunity and responsibility. Opportunity, because silver remains one of the world's most versatile industrial and monetary assets. Responsibility, because relying on traditional indicators alone may no longer be sufficient. The global economy has become too interconnected. A disruption in South African mining can influence platinum. A shortage of platinum can affect industrial purchasing decisions. Changes in industrial purchasing can reshape demand across multiple metals. Eventually, those pressures can reach silver. This chain reaction does not happen overnight. It develops gradually, often hidden beneath daily market noise. That is why the most successful investors rarely focus on individual price movements. Instead, they search for relationships. They study how one market influences another. They identify where capital is flowing. They ask why institutions are positioning themselves in specific sectors while public attention remains elsewhere. Perhaps the greatest lesson from platinum is not whether it will outperform silver. Perhaps the lesson is that markets constantly leave clues for those willing to look beyond the obvious. History has repeatedly rewarded investors who recognized those clues before consensus formed. The next precious metals rotation may not begin with a dramatic announcement from a central bank. It may not begin with an economic crisis. And it may not begin with silver itself. It could begin exactly where few people are looking, inside a smaller, overlooked market whose movements quietly reveal what sophisticated capital expects next. Whether platinum ultimately continues higher or experiences another correction, its message extends far beyond a single metal. It reminds investors that wealth is often protected not by reacting first, but by understanding first. Because in every commodity cycle, the biggest opportunities belong to those who recognize the signal before the rest of the market even realizes one exists. And if platinum is truly delivering that signal today, then the coming chapter for silver may already be unfolding, long before most investors are prepared to see it.